This is All of It on WNYC. I'm Allison Stewart. We're closing out this season of Broadway on the Radio with a visit from the cast of The Outsiders. In little over a week, next Thursday, June 11th at noon, the stars of the Tony winner for Best Musical will be right here in the WNYC Green Space performing live. Now, this is special. It's a free event. You can RSVP by going to wnyc.org/events. Please note the event is a first come, first serve, and RSVP does not guarantee entry, by the way. Now, if you can't make it in person, you can always watch performances on our live stream, as always, or you'll be able to hear it on the radio. Go to wnyc.org/events for more information. Now let's get this hour started by getting a financial life. It's graduation season. Millions of students are contemplating the next steps in life. That could mean starting a job or moving away from home for the first time. But one thing is certain. This transition comes with a bill or two or three. Financial journalist and author Beth Kobliner offered guidance to young adults when she published her book, Get a Financial Life, back in 1996. But a lot has changed since then, and she decided it was time for an update. The stakes are different for young people entering the workforce today. Application pools in some industries are more competitive than ever. Rents continue to rise, and the average age of a first-time home buyer is now around 40. Then there are challenges every generation faces: savings, managing credit card debt, repaying student loans, and finding the right insurance plan. The 5th edition of Get a Financial Life, Personal Finance in Your 20s and 30s, offers practical advice for navigating these obstacles. It is out now. Financial journalist and author Beth Kobliner joins me in studio. It's nice to meet you.
Oh, so nice
to meet you. I met you a long time ago, like 30 years ago.
I know. And we both look exactly the same.
Exactly
it's amazing.
The same. Listeners, call in. Tell us. How did you know you had your financial life under control? What were some of the biggest challenges you faced, whether it was credit card debt or student loans or insurance? How'd you learn to manage your money? That's a good question. And if you're the parent of someone in their 20s or 30s, what is the one thing that keeps you up at night when it comes to their finances? Our phone number is 212-433-9692, 212-433-WNYC. You can call in, you can join us in the conversation, or you can text to us at that number. So recently you said when the 4th edition of Get a Financial Life came out 9 years ago, only 17 states required high school students to take a course in personal finance.
Yes.
Have things changed?
Yes, there has been an increase in that. And I'm happy to say New York State just announced that they'll be requiring personal finance in New York starting this coming school year. I've actually written a curriculum for that and have been going to New York City high schools and talking to high school students about what they need to know before they graduate, to juniors and seniors, the very, very basics of credit cards and debit cards and starting to save a little, and of course college costs. So it all is very important, and the earlier you start, the better.
Do they understand how important it is?
They are amazing.
Yeah.
I've been to about 35 New York City high schools, a lot of them in Queens, my hometown. And I have to say, kids are so interested. They really want to know. They feel like, wow, this is something we're going to really use. Mm-hmm. And no matter whether they're going on to college or a credentialing program or a job, they understand this is the time to make sure they know some of the basics that they maybe they didn't learn it at home. Maybe they didn't learn it. They certainly didn't learn it in school. So they want to know how they can get themselves started off in a smart way.
What was something you knew that had to be in this edition of Get a Life?
Right. Well,
financial life.
There's so much that has changed. I think the probably number one thing is this notion of frictionless finance. It sounds so great, frictionless finance, but really it means now, we used to know when we used cash, we spent half as much as when we used a credit card. Now, when we just tap to pay, we're spending more. It's so easy to spend money. And I think that notion has become embedded in young people's lives, and they were born with this. They never had to. I mean, I met some young people recently, really young people, who hadn't seen coins before.
Wow.
So we're at a point now where we have to put a little friction between us and the payment. There's this new kind of payment plan called buy now, pay later, which again sounds really good. But really what it says is if you buy something for $100, you only have to pay $25. And you think, that's a good deal. And they're not going to charge you interest. Even better. The problem is you feel like, I'm affording something I can't really afford. Mm-hmm. And also I have this extra $75 to overspend. So I think that there's so many financial products now that make it seem so much easier to spend our money. And that's something that, young people, although they're aware of it, they were born into it. So they don't really know much difference.
It reminds me of when you used to get money from your parents and you'd come back and your mom would be like, where's the change?
Right. And
you better have change.
Right. Exactly. I mean, we used to have to pay for something, and if you get to the cash register and you don't have enough, you have to put something back, or you run out of money. It's so different now, and I think it makes it a lot harder for young people to really think about this. I also think for young people in their 20s, there's this trend toward these neobanks or cash apps, or like Venmo, and all these sort of fintech-like institutions that seem like good ideas. And in some ways, they can be very useful. They usually have great websites and easy to maneuver. But there are a couple of things about these. Often, they are not themselves federally insured. They usually have a relationship. They have pass-through federal insurance. So that's something to be aware of. But also, I think, again, it makes it very difficult to sort of dissect, okay, this is my bank account. Am I getting savings on it? Something like Venmo, you're keeping your money there and you're using it to pay friends and family. But if the money that's sitting there isn't getting interest. So am I getting interest? And also when these companies start sort of soliciting me for, why don't you try this cryptocurrency? Then it gets very confusing. In our day, you go to your bank, maybe you have an emergency cushion in your bank. Hopefully you get a higher interest rate on that. And then when you start to want to invest, you say, I'll go to a diversified mutual fund. Now, this is obviously in the best case possible scenario. Right. Not everyone did this. But there was a separation and there was a pause we would take to understand what our goals were and what our money is. And I think now there's a little bit more impetuousness. Particularly we have gambling websites now and prediction markets that young people are spending a lot of time putting their money into those too.
We're receiving a couple of tips on how to navigate personal finances from author and journalist Beth Koblener. She just released the revised edition of her book, Get a Financial Life, Personal Finance in Your 20s and 30s. Am I saying your last name right?
Perfectly.
Okay, I'm glad. Listeners, when did you feel like you had your finances under control after leaving the nest? What are some issues you struggled with? Give us a call, 212-433-9692, 212-433-WNYC. If you're the parent of someone in their 20s or 30s, what is one thing that keeps you up at night worrying about their finances? Or do you provide any assistance? Give us a call and let us know what's going on with you. Our number is 212-433-9692, 212-433-WNYC. I'll paint a nice picture. You graduate from high school, whether you go into the job market or you want to get a good house, have a family, a little white picket fence, maybe a dog.
Yeah.
How has that changed for people in their 20s and 30s?
It's so hard. Yeah. First of all, like you mentioned on the top, when I wrote the book 30 years ago in 1996, the typical age for a first-time home buyer was 28 years old. Wow. Now it's 40 years old. So that makes such a huge psychological difference. I think that a lot of young people are assuming they'll never be able to buy a home of their own. And one of the issues that comes from that is, there's some economists who have been talking about the fact that they kind of have given up. So they'll say, maybe I'll take a flyer on some prediction market, which I will, chances are, lose money, because now we know that those are usually the most of the people on these prediction markets are trained professionals who are looking at the data. So you have much more of a chance of losing. But I think that in the best case scenario, when you start that job, some of the basics of just saying for everything that comes in, I start a job, for everything comes in, I'm going to put 10% away. $100 comes in, 10% away. And this is what I talk to the high school students about, too. It's very clear guidance. Ideally, you get a high-rate savings account. There are banks that are paying, say, 3.5%. And building up a savings cushion of a few months is a good start. Then you can start looking to, if you have a 401k at work. One thing about this generation that's great, they're much more likely to put money into a 401k than my generation was 30 years ago, or even more than millennials were. So they are caring about their futures and knowing it's important. Also, the Secure Act of 2.0 required employers to start putting money in for, that's the defaults, that employees have money put away for them. So there are benefits of technology when you're saving automatically, when you're having your paycheck automatically put into an account for savings. Those are all great ways to use technology to get a financial life.
Let's talk about homeownership, because I'm curious if I'm a 22-year student or I'm 22 years old and I've been in the workforce for a little while, how do you approach the goal of getting a home now compared to back when 28 was the average?
Oh, it's so different. I mean, back then I would say, well, you might want to move back home. Now I'm saying you probably should move back home.
Yeah.
A lot of young people are moving back home, saving a year or two to just try to come up with some nest egg, because renting, like you said, is so expensive. Then when you get out, your first rental is probably going to be a couple of roommates, or what we're seeing a trend toward people moving to other cities and they work remotely. So you live in a cheaper city, but you're working somewhere, maybe, a larger city like New York City, and it's more expensive. But if you can work remote, that's a way to save money. Yep. I mean, I think people are becoming very creative. And then I think it's like 70 to 80% of young people who purchase a home have a parent help with some of that. It's a down payment or, coming up with the monthly mortgage payments. And that wasn't allowed 30 years ago. It used to be you have to come up with that down payment yourself. Now parents or relatives or friends are kicking in because it is so difficult for young people to get started.
I heard of a young couple that said, forget the wedding. Just give us the money that you would spend on the wedding for a house.
Yes, I've been seeing that a lot more. Some sort of, account, some savings account or some sort of cushion that people are doing, because it's true. I think this generation is really smart. I think they are savvy in many ways, despite the fact they were kind of born into this technological world. And now, of course, with AI, they're all very concerned about getting jobs and the fact of no one knows how jobs will end up replacing them. So in many ways, a couple of years ago, if you were a computer science major, it's like, oh, you got the golden ticket. You're perfect. You'll get a great job. Now it feels like, ooh, maybe that wasn't the right decision. Maybe I won't be able to get a job, or the job that I wanted, or the job that I thought I was, qualified for. So it is a difficult time, but I do think in difficult times we are seeing there's some strategies that people are putting into place. And the biggest one, I think, is just taking a pause and taking a minute and saying, okay, yes, I'm seeing this advertised or that advertised. I see, a lot of young people, 70% of young people get their financial advice from social media now and finfluencers. And some of that's very good advice, but a lot of it is paid advice. There was a time when you get unbiased information from magazines. 100 years ago, I worked for Money Magazine, and there was a separation of church and state, and we would never, And so I think it's important to realize for young people, even though they know it, sometimes in the moment when you're asked to, you see something and you just tap your phone and you get it, it's a little bit, it's so tempting, it's hard to resist. And I think just sticking with fundamentals, starting to save automatically, making sure you pay your credit card on time. This generation has very high credit card debt. And that's because they're having a hard time making ends meet. But it's really important to pay those credit cards on time and try to pay them off as quickly as possible. You know, the famous example, if you owe $1,000, you only make the minimum payments, it'll take you 13 years to pay it off. But if you pay just $10 more than the minimum, you could pay it off in 4 years. And that, particularly now, I mean, credit card interest rates, it makes me crazy.
Yeah.
They're 22% on average. When I was doing this years ago, they were like 10%, 11%. You know, the high rates were 15, 16%. It's really, really tough if you're just starting out now, or for people of all ages. And I think that being aware and making sure to pay your bills on time, but pay off that debt as quickly as you can, that's something I think is very worthwhile, a very smart thing to do.
Some text here. I'm in my 30s and I do okay paying for bills and such. I've recently found that paying for things in cash means that I do significantly less purchasing, especially online. Also, if you were places to take cash now, that's one less thing for me to buy because so many places don't take cash now.
Exactly.
This said, I'm loving this interview. Can your guest explain how to negotiate a bill appropriately?
Well, it depends what kind of bill it is, you know, and there's certain things. For example, if there's a bill that you got and there's a mistake, certainly calling the company. Now, it's so much harder to get people on the phone anymore. But when you do get someone on the phone, it's almost, a very strong position to be in to explain very clearly, look, I didn't pay this bill. I was away on this day. Or if you have a high rate credit card, it still works sometimes to call and say, you know what? The interest rate is much higher. Look at my credit score. It's excellent. I want to go to a lower rate card somewhere else. Could you lower my rate? Just talking civilly and calmly with the facts in front of you, I find continues to make sense. It is hard to get someone on the phone, though. You're going to be waiting on hold for a long time.
We are talking about Get a Financial Life, Personal Finance in Your 20s and 30s. It was written by journalist Beth Koblener. We are also taking your calls. When did you feel like you had your finances under control? What are some of the issues you struggled with? Was it credit card debt, student loans, figuring out insurance? How did you get a sense of how to properly manage your money? Or if you have a question for Beth, she's willing to try it. Our number is 212-433-9692, 212-433-WNYC. We'll have more after a quick break. You're listening to All of It on WNYC. I'm Allison Stewart. We're talking to Beth Koblener about her book, Get a Financial Life, Personal Finance in Your 20s and 30s. It's in its 5th edition. It's been updated for young people today. Let's talk to Richard, who is calling from Long Island. Hey, Richard, thanks for calling All of It. You're on with Beth.
Hi, Allison. Nice to speak with you again. Yes, Beth, I was just curious what you're advising people that are, graduating high school, getting into college, graduating college, relative to buying a car versus leasing. With the leasing option, you're kind of in a perpetual buying mode. You're paying off the depreciation on the vehicle right up front, and then you're basically in a forever buying mode on cars. You always want to have the next and the greatest. So I'm curious what your advice is
100%.
on that topic.
100%. Well, I would say if you need a car, you buy a used car. And there are all kinds of ways to figure out, is it good, what the mileage is, and there are all kinds of specifics to look into. But leasing a car only makes sense if you want to have the nicest, flashiest car out there. And I'm not sure what that reason would be. So I would say it makes sense to buy a used car used car will cost half the price of a new car. And it's, as people may or may not know, when you get a new car and drive it off the lot, it immediately depreciates. That is suddenly it's worth so much less than what you paid for it. Whereas a used car, if you get a good used car, it's a very, very smart thing to do, and you could drive it for years. Leasing does not make sense for young people, and it's hard to figure out why it makes sense for any people, honestly.
This is an interesting text. This says, does it make sense for me to try to buy a property for my kids when I croak? I don't think they'll be able to afford it otherwise. So that's a parent calling it who's got a kid in the 20s and 30s and thinking like, well, if they can't afford it till they're 40, should I do it now? Should I help them now?
It's a great question. My question back would be more about, are you sure they'll want that property? Are you sure they're going to want to live in that city? And it's a wonderful idea. So maybe putting that money in some sort of investment like, an index fund, a very low-cost index fund or low-cost ETF at a company like Vanguard or Fidelity. And I don't get any kickbacks. I don't work for any financial firms at all. But something that's a low-cost index fund that, historically they've done very well. And then they can take the money and use it for what they want to use it for. But it's a nice thing to do as a parent.
This is a more family-oriented question for your guest, but would she still recommend a 529C for kids? College seems so uncertain and potentially a financial misstep years from now. Is it feasible to think of a future IRA for kids? Or does it make the most sense for a New Yorker to get a New York fund or shop other states' funds?
Right. Great question. I would say, first of all, if you have a 401k at work that has matching, that would be your first stop. Then if you qualify for a Roth IRA, that would be your second stop, because that would be money that you can use, particularly if it's a Roth 401k, which is becoming more common. You can after a number of years, you might be able to borrow that money or withdraw some of that money without paying interest on the principal that you put in for the Roth IRA. The 529 is an excellent plan, and New York's is an excellent plan. So I think that sticking with New York's makes sense if you're sure your kids want to go to college. And there are provisions if you don't use all that money for college, you can turn that money over to your kids at a certain point. So I would say if you've used up those other options, then the 529 plan in New York State's a good place to be.
We got a great text that is specific to you. This says, 20 years ago, I was a poor grad student, but after reading Beth's book, I scraped together a couple $1,000s every year to put in a Roth IRA in a Vanguard fund. Recently, I looked at it and it's grown 20 times. And what I learned from the book influenced my money management in all subsequent years. A huge thank you.
Oh, that's so nice. Wow. Thank you. Yeah, it's been kind of wild. I am certainly a one-trick pony. I've been doing this for many, many, many years, 30 years. And I think that I meet people now in their 60s and even 70s, and they'll say, I didn't think I really didn't have any money, because no young person very few young people think, I have so much. I can't do it. But if you just put a few percentage points that, of whatever your income is, that over long periods of time, historically, that's grown. And they say, I have hundreds of thousands that I wouldn't have had otherwise. And I feel so great about that. My parents, my dad was a principal in New York City and my mom was a chemistry teacher. They did not have a lot of money, but man, were they good at putting it away in the retirement plan. And I grew up hearing about it all the time. It was such a big part of my childhood, hearing about putting the maximum they could into the plan. And I think that notion of small amounts can make a difference. I find that does resonate with the young people I'm talking to now in New York City public schools. And it really is something that when you're young, you have that advantage of time.
Let's talk to Lisa, who's calling from the Upper West Side. Hi, Lisa. Thanks for calling all of it.
Hi. I have a question. My grandson just graduated high school, and he has a credit card. But my question is the following. The family has a goal of keeping an excellent credit score. Is it better for him to have all of his purchases on one credit card and pay that off, or have 2 or 3 credit cards, which would only be 1 or 2 purchases a month, and pay all of those off? Which looks better?
It's a great question. It's a very, very good question. So generally speaking, I guess my first question to you would be, is it in his name? Because if it's in his name, he's able to build up credit in his own name, which is a very good thing to do. A lot of times young people have an authorized card that it's actually in their parents' name and they're getting to use it. So first and foremost, I would say if he's had an authorized card and he's shown that he's responsible, then he can have a credit card in his own name, apply for one, and start using that regularly. Now, people get really complicated with the gaming of the whole credit card thing because credit cards look at what they call your utilization ratio, and they want you to stay, basically, if you have $1,000 amount that you can use a maximum, they want you to stay to 30% of that. So they only want you to use $300. But in his case, since he's paying it off in full every month, that's the best thing you could do. A lot of people get confused. They say, oh, I heard to build my credit score, I have to carry debt and pay interest. That's not true at all. Paying it off in full every month is good. So in his case, technically, if he had a couple of credit cards, maybe that's slightly better for his credit score. But I would say he's a high school kid. He's going off to college. Let him start with one credit card in his name and make sure he pays it off in full every month to start. Then after a couple of years, he could get another couple of cards.
Let's talk about student loans quickly. What has changed about student loans?
Right. Well, if you take out a loan after July 1st of this year, you are left, those new loans will be paid back under 2 different plans. It's been limited, it's less generous, but it's simpler. And you either do the standard repayment plan or there's another kind of plan, which is basically more like an income contingent plan. So if you make a lower income, that plan would be good to look into. Go to studentaid.gov to look at all the details. If you have older loans, you have more choices of paying it back. It is so complicated, but it's important to do it. And if you just graduated, you have a 6-month grace period before you have to pay back those student loans. But still, as soon as possible, once you get home and you celebrate and you open your graduation presents, then go on studentaid.gov and make sure you know what you owe, where you have to make those payments. And in, 5+ months, you'll have to start paying that back. And that's very important, again, for your credit score. You want to make those on-time payments. There's also public student loan forgiveness. So if you qualify, if you're working in a certain area, you're a teacher or a nurse, look at that, because that could be a real boon for you. After 10 years, your student loans get forgiven. So there's still some options to choose from, and it's important to make sure to, once again, make payments on time.
And you said that you can never be too young to save for retirement.
That is true. I mean, starting with small amounts now, if you have a job and if your company doesn't have a 401k, then opening a Roth IRA is a great thing to do. But if your company has a 401k and it has any kind of matching, that's free money to you. For every dollar you put in, they'll put in 50 cents or $1. That's an immediate 50% or 100 return, guaranteed after-tax rate on your money, and you can't get that anywhere. So that is absolutely a very important thing to do.
I'm going to take this book and I'm going to give it to my soon-to-be graduating son.
It's
a really good book. It's terrific.
Thank you.
The name of it is Get a Financial Life, Personal Finance in Your 20s and 30s. It is written by Beth Koeblener. It's her 5th edition. Thank you so much for taking our listeners' calls.
Thank you. Thank you so much.